the CBO, U.S. Congressional Budget Office, put out their long-term budget and economic outlook. So they make a bunch of predictions. This one is focused on a 10-year period, 2026 to 2036, but they also make some projections out 30 years to 2056. And if you've been on Bitcoin Twitter or macro Twitter for any amount of time, you'll see that when these things get published, there's a lot of commentary around them. The biggest kind of takeaway from these things is that the US Congressional Budget Office, this isn't like some Austrian economics or gold bug or Bitcoin person doing this, right? This is like career government bureaucrats that are going through the numbers and just saying, hey, if trends persist and legislation persists as it is now, what do the government budget numbers look like on a long-term basis? And the two big eye-popping things that they go through, and they always put this on the same page, one is what's the annual deficit as a percentage of GDP? And they show it here in history. This chart would be more interesting if they went back to World War II, but they go back to 1976 for some reason. And you can see that it hovers around. It's not a straight line. That should be the first takeaway. Depending on what's going on in the economy, it can be lower or higher. The only time it was ever a surplus, this is noteworthy, was the 90s, which people are probably aware of. We had good economy back then. There actually was, I don't know if bipartisan is the word, but there was enough support in Congress to actually cut some spending. And
there was a semblance of fiscal discipline.
Yeah. And it was
bipartisan agreement on fiscal discipline.
Yeah, it was bipartisan enough that things got passed. And we actually had some years of a budget surplus. That just seems completely impossible now. And that late 90s was the last time we had a budget surplus in the US. So now it's just been varying degrees of deficits. And normal is like probably between 1 to 4% is normal, or has just become accepted. And then if there's a crisis, you can see it spiked to 10 or above 10% around 2008 and the great financial crisis. Then it comes back down, but it never quite comes back down to 0 or 1. It came back down to maybe 3 or 4%. And then it's gradually increasing. And then COVID happens, it spikes up to 15%. And it doesn't stay at 15%, but when it comes back down, again, it kind of resets to a higher baseline. In this case, I think the lowest we've gotten post-COVID has been around 5%. We probably got up to 7% in a few years after COVID. Most recently, they're quoting a number of 5.8% debt to annual deficit as a percentage of GDP. And they're saying that it's going to gradually grow to 6.7% over the next 10 years. But one of the funny observations with these numbers is that you can tell they're always predicting gradual expansion, gradual extrapolation of trends. And if you look at that, the numbers from 76 to 2025, what we actually have experienced, there is not a 10-year period where it's just this gradual, slow increasing line or a flat line. There's always something happening to make it move pretty dramatically. So I would bet against the line just being slow and gradual for the next 10 years. And before we go to the next one, if you want to lob any comments in, Brady, let me know. But I think the takeaway here is that there's really nothing that would suggest we're going to take deficit spending as a percentage of GDP down to 0, definitely not to a surplus. And final thing I'll add is Scott Bessent, when he's been asked about this, he talks about a goal to get it down to 3%.
Yep.
So even this pretty lofty, ambitious goal from a Treasury Secretary who wants to talk up the ability to manage the budget, he's not telling you balance the budget. He's telling you manage the budget to 3% deficit. So that's like a best case scenario, in my opinion. Okay, next one here. So this is federal debt held by the public. The public here really just means there's intra-governmental debt. So if there's a government agency like the Social Security Administration that holds treasuries, they don't count that. And that is logical. If one part of the government owes another part of the government, it cancels out. So they look at debt held by the public, which is 101% of GDP right now. But that, FYI for anyone, that's the discrepancy. You'll often see total federal debt to GDP. That would be, I think, more like 125. If you strip out that intragovernmental debt, it's lower. And that's what the CBO looks at here. And this one is not, I wouldn't even call that gradual. To me, that looks more like a hockey stick, just up and to the right. And that's what they're saying. They're saying, hey, if things keep going the way they are, we're going to go from 100% debt to GDP to 175% debt to GDP. So this is the current trajectory. GDP, there's two ways that this could be better or worse. We're talking about a ratio, right? Debt to GDP. GDP could be better than the CBO is forecasting. I think they generally forecast like a 2% GDP. If you ask somebody in the administration, they're going to tell you, no way, we're going to be much better than 2% GDP. Maybe they're right, but that's the rough number that they're using, 2% annual GDP growth. And then for the debt, the other part of this ratio, it's at least going to grow this much. This is like a minimum in my view, because they're not saying, oh, what if another GFC happens? What if another COVID happens? And maybe we'll tease a little bit some of those potential big prints. But this to me, this hockey stick to the right is like more so like a baseline of what to expect debt to GDP to do. It could spike up at several different points.
So that's the CBOE report, and that's good coverage there, John. And I think maybe the biggest news of the week actually on the monetary front here is the tariffs. The Supreme Court has struck down Trump's tariffs. Obviously, his signature policy, at least that he's highlighted in 2025, struck down 6-3. Chief Justice Roberts wrote the majority opinion. Thomas, Alito, and Kavanaugh dissented. These tariffs were based in law. They were based in the IEEPA, which is the International Emergency Economic Powers Act. It's a 1977 law that gives the president broad authority to regulate economic activity or transactions during national emergencies involving unusual and extraordinary foreign threats. So the Supreme Court said that this did not rise to that occasion, and specifically the reciprocal tariffs, the Liberation Day tariffs, and the fentanyl-related duties on Mexico, Canada, and China. They did not address the refund question. They were silent there, whether the $175 billion already collected needs to be refunded. So that question remains unanswered. Trump had claimed $600 billion in tariff revenue, as the number here just said $175 billion. That was the targeted tariffs, the Liberation Day and fentanyl tariffs. The Bipartisan Policy Center tallied $289 billion gross for 2025. CBP reported $200 billion collected, and the IEEPA specific tariffs accounted for only about $129 billion. So massively overstated numbers that came out of this ruling, that came to light out of this ruling. The bigger picture here, this is really, to me, a separation of powers story. The president needs congressional authorization to levy these kinds of tariffs, and the Supreme Court saw it the same way. So it's a blow to Trump and his signature policy, economic policy, especially global economic policy, and probably domestic as well. This is, it's good to see the separation of powers working and intact, and a presidency that's really trying to overreach and expand presidential authority, which is a stated goal, by the way, of the administration and those who surround the president. They're a group of people who've have this philosophy that the president, you often hear it called the imperial presidency. So this is a victory for the idea of the separation of powers and the balance of powers in the federal government. And I don't know economically the outcome of this, but this seems like the tariff numbers have been lower, and I think at least, or lower than Trump was reporting. And I think at least there might be a little bit less volatility and uncertainty after this ruling in terms of tariff-related uncertainty.
Mm-hmm. Yeah, I think in terms of market, there's different ways to gauge where we go from here. There's commentary from the administration, which they've made today. There's commentary that they've made weeks ago as they were flagging this ahead of time, saying, hey, we might get an outcome in the Supreme Court that we don't like. They have, Trump and Kevin Hassett and others, said, hey, we have other ways to get these make a case for them. I'm not going to claim to be an expert on what arguments they're going to use, what legal precedent they're going to use, but they have said, we're going to try and get the bulk of these tariffs to stay in place one way or another. We'll see where that turns out. We'll say, I'm just kind of laughing at it because you kind of almost have to laugh at some of this stuff. But some of the comments today, Trump said he's imposing another 10% global tariff, and that the tariffs that were struck down today are going to remain in effect. So
Yeah.
I'm not going to pretend to know where it all ends up. Those are comments being made by the administration. The other thing you can look at is what is the market doing as a reaction. The S&P and NASDAQ are up between 0.5% and 1%. So there's not like some massive rally. I don't think they're really pricing in, oh, okay, all the tariffs are definitely going to go away. Treasuries or yields are not really doing much at all today. Gold is up 2%. Silver is up 8%. Hard to say if that's a tariff related price move. If I were going to make the case that it were, part of the CBO projection, we didn't show this part, it's not critical, but when they were saying that the CBO, they were comparing forecasts in the past, and they were saying, hey, actually the debt we're going to add over the next 20 years, it's not going to be as bad because of tariff revenue. So there's an argument to be made that says, okay, if all or most of that tariff revenue is going away, then the deficits are going to go blown out even more, incrementally more, and maybe gold is reacting to that. I'm not saying I necessarily believe that, because precious metals prices have been very volatile, and I think silver is responding to idiosyncratic things. But as I look at the market reaction, my general take is the market is still playing wait and see on this one, to see where there's just not enough information yet, in my opinion, to know where this all lands, tariff wise specifically.
So you mentioned the next 20 years of the federal debt and where it's going, and that Trump was claiming that these tariff revenues would help bend that curve downward. This comes from the Global Investment Strategies, a Bloomberg research report. And this is the national debt chart here with the projection for it to rise by $2.5 trillion a year over the next 10 years, putting the 2036 deficit at $64 trillion. The letter wrote that U.S. national debt is set to surge, according to CBO estimates. As a result, U.S. debt will likely reach a record $64 trillion in 2036, doubling from 2023 levels. That would be triple the debt recorded in just 2018 before the pandemic, all while annual interest costs on federal debt are expected to be more than double to $2.1 trillion over the next 10 years. This also assumes the economy will not fall into a recession over the entire period. $64 trillion in debt is now the base case. And they finish with, how did we get here? We were joking before the show that we think they probably have an opinion on that, but it's a good little way to finish up an engagement tweet. John, let's just lay it out. I think we don't need to make any assumptions, although we think safely could assume that most people listening or watching to the show would have formed a solid opinion about the answer to that question. How did we get here?
Yeah, I gotta love how they ended that one. I guess my take on this is I want to say boiling of the frog analogy to a certain extent, but then it's what have we been doing for the last, really since, I would argue, since the GFC. Maybe it goes back further than that, but it has been a gradual, maybe you could argue since 1913, it's been a gradual print and then periods of a big print. Like, that's just what we've been in. And apologies if you're hearing the New York City sounds, but it's been a gradual print, and then that can go on for a while, for decades at a time. But then there's some crisis and there's a big print. And that just is like the numbers we went through before. Even when times are quote unquote good, we're adding debt, where surpluses are almost never happen. So it's gradual. These trends are gradual. And then every once in a while that you get the monetary and debt bazookas that come out. So that is my answer for how did we get here?
Yeah, we are here because of structural truths, I guess I would say, ranging from the structural truth of fiat money, just the way it's engineered, the very basic characteristics of it, to the structural truths of our political system, right? It's not very conducive to making hard choices, and that including managing a budget wisely. And so the combination of those two the irresistible power of the printing press combined with the difficulty to make difficult decisions in our political system has led to where we are now. And it's just, well, you need to interrupt one of those two fundamental things. And the former, the interrupting or fundamentally changing the way our government works, is really hard to do. It's very costly in terms of like war, or it's costly in time in terms of trying to change it from within. But we do have something that can fundamentally change the other input there, which is Bitcoin, changing the nature of the monetary basis of the world. And that may just be enough to rescue us. That's our hope anyway. The Bitcoiner hope.
Correct. And it doesn't mean everyone's always going to see it like that. Like we will. There might be long stretches of time where people say, hey, why do we need this thing? Oh, the budget's going in a better direction for now. It was actually interesting that we looked at that deficit chart earlier, because I haven't thought about the fact that we actually had a budget surplus in the 90s. Yeah. I haven't thought about that for a long time. And just think, if you were an investment analyst, a macro guy in the 90s, it might have been tempting to think, oh, wow, we're going to balance our budget and we're going to get rid of this debt, and this is the new path we're on. And it turns out that was a flash in the pan. That was the exception. And it, like, just a handful of years later, it went back to massive deficits and a big print. Yeah. So there might be times where it seems like, oh, why inflation's low-ish? Why do we need this fixed supply, digital, decentralized, peer-to-peer monetary asset? Yeah. But I think the long-term trends are just very clear.
You can check us out at swan.com. We will help you invest in Bitcoin, help you build wealth over the long term. John is managing director at Swan Private, and so he works with clients every single day, every single evening, every single weekend. He works a lot, and that's because he really takes seriously building strong relationships with clients. And I think that's a value that Swan uniquely brings to the Bitcoin industry, is really great, real human relationships in this age of AI, to help you figure out and to accumulate Bitcoin for yourself and for your family generations down the line.